We got right up into that moving average resistance, which coincided perfectly with the 50% retracement.
Well, hi, everybody. Welcome back to the Comstock channel. I'm Marlin Bohling with you. Always a pleasure to visit with you on these weekends. Here we are Friday, and we're wrapping up the markets for this trading week. And wow, the cattle market and hog market today accomplished what SpaceX couldn't yesterday. What a move higher. Just went into orbit. Now, the grains, on the other hand, they kind of fell with a thud at the end of the week here, but it was an adventurous week. So I have Relph with me here. He's from Comstock Investments. Let's talk about this, Eric. We'll start with the grains here. Kind of a yawn fest on the final trading day of the week, but that kind of hides what took place earlier this week.
Yeah, today was a much needed reprieve from what we've been experiencing throughout the week. And honestly, I've been kind of wanting to look at this and just haven't had the opportunity. And so I'm going to pull up a couple of things here and take a look, because I'm pretty certain that even through all of this chaos, we really weren't too far changed for the week in the row crops, at least. So starting out the week, let's see, we finished last Friday at 469.5, and we finished today at 469.25 in the May corn. How's that for as close to steady as you can get? In the case of the May soybeans, closed out this week at 1025. Last week we finished at 1025.75. So it was like I kind of anticipated it. All the chaos meant nothing in the end. I mean, we were just near steady for both corn and soybeans after ranging like 40 cents in both of them for the week. It's just unbelievable.
So when you look at the corn and soybeans, for example, do you consider us to still be in corrective territory, or how do you look at it now?
I'm thinking we're in a corrective bounce here. We did achieve some significant resistance of late, particularly corn. Soybeans have been a little bit different story, but the corn market specifically, 504 in that March contract was huge. We hit 504.5. And then we set back 72 cents to 432, tried to stabilize there, punched a new low by several cents, end up in the high 420s for the low on the day, then bounced right back up, closed the day above the 432 mark, then saw follow through to the top side. I mean, this was just textbook technical resistance and support. The surprise was that we dropped 80 cents in 11 sessions in that March contract, and all the other contracts weren't too far behind as far as old crop goes. New crop wasn't keeping that kind of a pace, but it was really nice to see the stability once we did make those lows. And I think, at least for the short term, the lows are behind us, barring any bearish inputs, particularly swirling around tariff headlines moving forward here. That's where the trade's at.
Well, I guess the trade has to work with the Ag Outlook Forum numbers for the time being. But my gosh, here we are a week deep into March already, and it won't be that long. And we'll get our planting intentions report at the end of this month already.
Last day of the month, we'll get that prospective plantings report. And, right now, cotton's actually showing a little sign of life, trying to fight here this week. And we can take a look at that here in a little bit. But, at the end of the day, you look at the insurance guarantees, and there's nothing that's even close to corn for most producers. Now, those that maybe have their soybean inputs are so much cheaper, maybe their equipment's better set up, whatever the case may be, then maybe you've got an argument for soybeans. But all in all, I think corn's going to be stealing acres from anywhere. All the other major crops look to be favoring corn right now.
Any comments on the wheat trade? It has shown some signs of life, trying to bounce off of that bottom a little bit, but it just hasn't had too much success here so far.
You may be trying to bait me into cursing on the air here, Marlin, but I'm not going to do it. I have not been pleased with what we've seen out of wheat. Now, I'll show you what I'm referring to here. Some key contracts, right? May Chicago, for example, makes a new low on Tuesday, recovers Wednesday, Thursday, then back down here today, although finished well off of the low. So I was glad to see that, but still a lower finish for the week after making new lows. So the weekly chart, which we can take a quick peek at that, but just looks abysmal here of late with new lows here this week. Now, that long tail on the weekly chart might entice some technical buying, but similar story in the Kansas City. Looking at the weekly, new low, left that long tail, might attract some buying, but these last 3 weeks have been a struggle for the wheat market. And I'm hoping that what we saw to finish the week is indicative of what we may see moving forward. But What I'm hearing now and what I saw driving this past week, I left Northwest Iowa, went straight down to Woodward, Oklahoma, spent several days there with family, and then came north from Woodward all the way into Nebraska, and then across Nebraska through the blizzard, and I-80's closed, and so I didn't get to see a whole lot. But in Nebraska this time of year, there's not a lot to see. However, in Oklahoma and Kansas, the wheat that I saw, boy, it was grazed off hard. And you could tell that they had just run it down to the dirt. And it's time to pull these cattle off. And there is a lot of cattle still turned out as of last week. And then the weather moved across. And so they're probably a little hard pressed getting them moved before next week. And then it's time. You got to have them off by the 15th of March. So
interesting stuff, though. I mean, the way the livestock trade finished the week, I want to turn our focus to that here for a little bit, because that got the gold star. But how come on Friday?
It's honestly a little tough to figure out the why of it all, other than technical buying. You blew out new highs in several of these feeder cattle contracts, new contract highs. Fat cattle, that isn't the case, but you're at the highest levels you've traded in quite some time. And really, the only thing I can point to that is a bullish enough input to be getting this kind of response is the idea of trade relation issues with Mexico and Canada, both, where you're going to be limiting the supply of animals coming into the U.S. There's a lot of back and forth trade that goes on depending on the size of the animals. And, they, like Canada, David Cruz will say often, Canada sends feeder pigs here and then takes pork away. So they, the sow units up there send the feeders here. We grow the animals, slaughter them, send the pork back to Canada. The feeder cattle that are raised, produced in both Mexico and Canada often come to the U.S. to get finished and slaughtered. And so if that supply, in the case of the cattle, is cut off because of this situation, then we've got a real supply problem at a time when we can ill afford it.
So what does that do? When you look at the charts, you look at live cattle and you also look at feeder cattle. Both of them looked like they were making a head and shoulders formation, and then they blew it out and faked everybody out and went higher anyway. That's kind of odd. That doesn't happen that often.
I went back to the April feeder cattle because that to me was setting up the most definition on the head and shoulders front. But you take a look at the April feeders, get back to the daily, sorry. And, we had come up here, spiked high, broke down neckline, built this up, come back. And now where I got a little concerned was on this day right here, February 24th. If we saw any follow through there, then that broke down the formation. And we saw follow through immediately the next day. And then 2 days later again. Now, the April, as we're looking at it here, has not made a new high. The previous high on January 29th was 279. Today we had a high of 278.75. That could serve as a double top. I mean, any technician is going to look at that as a double top, but that could serve as a resistance level that impacts the entire complex. And the April was lagging a little bit what the May and August were doing today as well. So I don't know if that's enough to outweigh the general market sentiment and what we're seeing in some of these deferred contracts. I mean, you look anything August on, and you have big blowout contract highs here today.
The thing that impresses me, Eric, is the fact that the cattle market acted the way it did in the face of just a collapse over in the equity market this past week.
Yeah, equities were sharply lower. Grains, even while they were making their sharp recovery the second half of the week, grains higher, equities lower, and cattle still resilient. It's pretty remarkable trade, honestly. And I don't know if it's just the tariff situation, if it's a general market sentiment thing, if it's just stop order running, or if it's a combination of all of the above. But our fed cattle cash is lower. Our feeder cattle cash is lower. Box beef isn't going anywhere this week. I mean, it's lower than what it was a couple weeks ago, but it's really not made any major moves this week. It was higher at midday today, but you're not seeing the movement in the beef that would propel this. You're not seeing the kind of cash trade that would propel this. I just can't really pinpoint anything that says, oh, that's why.
Well, I heard some talk earlier in the day here on Friday about the basis in the cattle market on the nearbys versus deferreds, and that things were changing. Can you address that for a second?
Well, the biggest thing that took place was we got rid of the February live cattle. Once that once that board, the February board, was gone, then you had an April board that was far lower than what the February was. And anybody that was hedged off against that April had an opportunity to capture a pretty strong basis right there. And so you did see a lot of that this week, where you may have, whether it was contracted or there's not been a lot of negotiated trades. So I can't say it was a lot of that going on. But once that April became the front month and you had that kind of a basis, they were jumping, and it was happening pretty noticeably. I mean, several thousand head on Tuesday immediately trade. Well, that's a day after we established the new position in the April contract. So there's definitely a lot of that going on now versus the deferreds. We're just going to have to see what the cash does as we get closer to some of those contracts. But the shift that we saw from February to April definitely warranted some basis jumping, and it warranted the April moving higher, which we saw.
Does that present any opportunities in the trade, and also on things like LRP coverage? I know you've been talking with people about that lately.
Oh yeah, that's been a constant conversation, and a lot of folks are reluctant to do LRP because the premium is not cheap. There's no question about it. It is not a cheap product, but I'm looking at some live cattle for some folks yesterday and spending $65, $70 a head to insure $2,300 a head seems pretty reasonable in my opinion. But days like today, when you have 6-figure margin calls and things like that to deal with, are really, to me, the biggest selling point in an unknown market. And really, nobody knows what the industry movement's going to be moving forward, because nobody really has a grasp on what kind of heifer retention we have or when that exactly started. We know that we've been doing it some of late, and my contention has been that it's really just gotten going here of late. But I was actually looking through some data earlier this week that would indicate maybe as much as a year ago, we were starting to see some heifer retention. So my point being with all this is we are just kind of lost as to how high this cattle market could go. And so the big selling point to me with LRP is let somebody else fund it, defer the payment, leave the top side open, and guarantee you can lock up these prices that we have today. There's contracts we're going to be able to lock up some 280 feeders tonight when the new quotes come out. I just think that's good business. And if the cattle are sold when we get to the end date, well, you just use the premium from the sale and pay your insurance dues. If the cattle's still going higher, you're just selling them for that much more. If it does collapse, you'd be glad you had it.
What about the hogs here? Boy, they put in quite a week after it looked like the party was all over, and now they've come back. Are they now at a retracement level on a correction back upward, or what?
So we'll take a look at the June hogs real quick, because I haven't had a chance to chart those retracement levels, but it just takes a second here. Yeah, you might be paying closer attention than I was to some of this, Marlin. We got right up into that moving average resistance, which coincided perfectly with the 50% retracement. And we achieved that in just 3 days. Of course, it only took us 3 days to drop off too. So, this is, we're kind of getting into the thick of it. We get another $1.50 higher, that you're talking 62% retracement at that point on some significant contracts that are garnering a lot of attention right now. So, but to your point, it was a really impressive week. I think what we saw here today shows that the resistance is going to be respected, and it's going to be a little bit tough.
Well, we had a lot to talk about here this week, and now next week when we come back, we're going to be in the second full trading week of March, and we're getting ever closer to seeing the planters start to roll. I'm hearing a lot of talk about dry conditions in the western half of the Corn Belt this year. Eric, does that affect your marketing plan in any way?
Well, you've got to be cognizant of it. It's kind of a double-edged sword, though. Initially, you would say, okay, let's hold off and see if we get some adverse weather conditions. You don't want to be a crop killer, but by the same token, you have to think at some point there's going to be an opportunity, a better marketing opportunity that doesn't destroy our livelihood. But by the same token, if we do get into a drought situation, are we going to lose those added acres of corn because people went back in because of dry conditions and did something else? There's still some of that can go on. And so maybe we plant, I don't care how many acres we plant. It matters how many we harvest. And so this could get interesting as we move forward.
Well, it's good to catch up with you again. Thank you for the time. I know you've been on the road, and I've been on the road here the past week or so. So I'm glad I was able to catch you, and we're both back home and trying to lick our wounds here from a lot of travel. But appreciate that, and we'll talk with you again next week. Eric Relph, of course, is with Comstock Investments. And that'll do it for this episode. We'll catch you, I guess, after this weekend break. For producer Breanne Jenkins, I'm Marlin Bohling. We'll see you next time here on the Comstock Channel. Futures trading involves risk. The risk of loss in trading futures and/or options is substantial, and each investor and/or trader must consider whether this is a suitable investment. Past performance is not indicative of future results.